We're up and running. Hey, everybody. Colin Plume, CEO, Noble Gold Investments, My Digital Money, and a few other things. Got my buddy Jake Bell here, Senior Sales Associate at Noble Gold Investments. And it's been an exciting few days. We're going to get right into it. I'll just lead in. We are going to talk about the tariffs. I know people want to hear it. We've been getting questions about it. They want to see how that's going to affect their finances. So we are going to talk about that. But just high level, 25% tariff went into effect on Canada and Mexico last night, 20% on China. We'll talk about some of the items that we import from these places that will be affected. We have some charts that I think are important because at the end of the day, I don't think it matters unless you know what these items are that are going to cost more money. We're also going to talk about some of the reactions that we saw out there. But before we do that, we got to get into Trump, Zelensky, their meeting, the after effects, what happened during the meeting. So I got Jake here who's going to dive right into that. And, my first question to Jake was, what do you think about him not wearing a suit ever? Is that a disrespectful sign? Is he trying to send a message that he's a wartime general? Like why can't he put on a suit like everybody else in those meetings?
It's a good question. And, everyone seems to have their own opinion on whose fault it was. I'll say right off the bat, I don't think anyone's really happy with how that Oval Office meeting went. I think we all reasonable
we
people
all lost.
wanted. Yeah, we all lost. We wanted to see forward trajectory towards peace. And it is telling that someone wouldn't present themselves appropriately for such a meeting if it's so important. And I think that kind of played out within him overplaying his hand. Now, again, everyone's got their opinion on that. So I'm going to leave who you want to blame alone. I want to talk about what that semi-formal meeting they had yesterday with NATO and what I think they were talking about in the positioning. So, again, it was a non-official meeting because the U.S. wasn't a part of it. It was an emergency meeting. They all got together. And I heard a lot of talk about Article 5. And so what is Article 5 with NATO? Well, basically, it's a clause for the treaty signed in 1949, the North Atlantic Treaty. If you attack one, you attack us all. That's basically what Article 5 is. And so it seemed like Zelensky was going to try and throw the gauntlet down and force our hand and kind of impose that upon the United States. And I don't see that working out for him, and I don't think that's going to happen. But I imagine it came up. And just to give you some references to what Article 5 is, it's only being enacted one time. That was in 9/11. All the countries need to agree on it. It's not a vote. It's not a majority thing. It has to be a unanimous decision. And so I imagine Zelensky yesterday was kind of testing the waters. And I don't see that really playing out, but there was a lot of chatter about it. And I have this feeling that Trump might be looking for a way out of NATO. And I imagine that those countries are aware of it, and we obviously fund it. And so I don't think they're going to try and force our hand. But it would, based on the energies, the personalities in that Oval Office meeting, anything's on the table at this point. So if Article 5 doesn't come through, there's another layer to this, and I'll be quick on it, but it's the EU defense. And EU defense is not the same as NATO, but they're pretty aligned on most subjects. And they have a Section 42, which basically says the same thing as Article 5 of NATO, just a little more vague, and it's never really been enacted. So I imagine yesterday's conversations were kind of in that ballpark. And we can kind of speculate from here what I think is going to play out, and obviously keep the focus on financially. But are you with me so far there, Colin?
Yeah. Well, and I think, there's a lot of moving pieces. One of it is the idea that if the U.S. continues to hold back any funds to the Ukraine, Zelensky's looking for funding from other, countries, right? I mean, I think that's part of what's happening here. The thing in the meeting was, and going towards a peace settlement, I think as the U.S., we really wanted to secure these rare earth metals and minerals that are available And I think that is the thing that I really wanted to come out of this meeting, because we're already, a few hundred billion in the hole, if not more. So how do we, how do we gain anything out of what's happening here? And I think that gaining the ability to have these rare earth metals, lithium, titanium, zirconium, graphite, I mean, these are all things that we need. So the idea that we could get access to these would make the loss of the few $100 billion a little bit, easier to swallow.
Agreed.
And I think that that was, hopefully the goal of that meeting, which went sideways, unfortunately. So I think there is going to be another meeting. I think we are going to come back to the table. But ultimately, I think we're in a much better position than we were before that meeting. And I hope we can secure some of these rare earth metals. Ultimately, with what's happening in the world with Russia and China and a lot of these countries continuing to gobble up mines, and China has the majority of the rare earth metals on the world in the world. We need that strategic edge, and we need it to do a lot of things that we need to do in terms of the world and our industry.
Sure.
So that was the thing that I was hoping would come out of it, but I think it'll probably just take a few more weeks. But I do think there is a deal there for us that's going to happen.
Agreed.
Hopefully in the future.
And obviously those metals are a necessity, and we do
Right.
need to recoup some of these losses somehow. And that's, I mean, that's Trump's wheelhouse, right? Making lemonades out of lemons. And I do think the thing he did correctly was he drew a hard line. It wasn't pretty, should not have been done with the cameras on. I think that was part of JD Vance's point, but I think he drew a line in the sand that he made it clear that we're not going to get steamrolled in this conversation. And
Mhm.
Zelensky, you don't have the cards to push us around. We're just not going to let it happen. So I do think that going back to NATO was Zelensky testing those waters, seeing what sort of support he has over there. I don't think it's going to be anywhere near what he needs. I mean, just look at the GDP levels of all NATO countries. I mean, they don't even add up to ours. It's not even close. So
Yeah,
um,
absolutely.
I think you're right. I think we're in a pretty good position to revisit that conversation. What is that going to look like? How are we going to bring them back to the table? I mean, obviously there were some egos involved there, and that's the real question mark, is the human element of this.
Absolutely. Yeah, no, I don't know when that meeting will happen again, or I doubt it'll happen on TV, as it did
Yeah.
this last time. Anything else, Jake, on the Trump Zelensky? Any other ideas or anything else that people want to
Yeah.
know, or
Yeah, I got a prediction, because Trump's going to talk tonight, and the online posts and social media stuff seems to be it's going to be this all about Doge and that thing. But I think there is, what I really want to talk about with our audience is the financial impact of any decision made tonight regarding NATO. Again, I get the impression that, Trump's probably willing to exit completely, maybe with the idea of re-entering based on new negotiated terms. But the financial fallout of us leaving NATO would be rather impactful. I mean, right off the bat, for all of NATO's shortcomings, I mean, I think we all want more. United States citizens want more out of NATO for us based on what we give to it. It does offer stability, especially in that region. And obviously, markets like stability. And I mean, you started our talk off with tariffs, and look what happened last night across the board. Markets do not like instability. And so, should NATO be dissolved or have all of its teeth taken out of it, right? Because if US steps out, I mean, I think it's pretty reasonable to see maybe Italy and Hungary follow suit. So we could really see some things dissolve, bring some instability. That brings, especially towards the Baltic and Poland regions, I think we could see heightened aggression from Russia if NATO's not there to implement sanctions, or whatever their tools are in their bag. But if we see that, I mean, the impact in Europe, right? They would have to cover the cost. They would have financial impact. Their indices would fall. I would imagine the euro would probably drop.
absolutely.
So I think safe haven demand would obviously increase subsequently.
Mm-hmm.
And I have one final kind of point to bring in, and this just layers on top of this. We have our central bank here, and everyone talks about, everyone's got their opinion, but the EU has the European Central Bank, and that's of course based out of Frankfurt, Germany. They have one central bank for 20 countries. 20 different economies, 20 different GDPs, 20 different schedules, one policy, one monetary policy coming out of Germany. And so it's not like the EU is just rife with financial stability. And if you bring the prospect of them losing that stability through any sort of volatility with NATO, and again, I think we could see a lot of ups and downs in a very short period of time. It could be happening right now while we're talking. The financial situation over there it's not like ours over here. It's very different because of that central banking situation. And so the mind can easily start to see one decision snowballing.
Absolutely.
And financially that could get very interesting, especially for precious metals, safe haven, cryptocurrencies. So I know that's kind of out of left field there, but you tracking with me? Do you have any thoughts on that?
Absolutely, yeah. Well, and I think that's why people are here. They want to hear what are some of the repercussions of a lot of these meetings, and yeah, us pulling out of NATO would obviously be a tremendous blow to Europe. So we'll see what happens today. We'll see what happens with Zelensky. Lot more happening, but Jake, as always, good to have you here. Excited. I'm sure it's quite busy on the phone, so I'll let you get back on the phones and talk to clients and get them into the good stuff, get them into some gold and silver. And it's I know there's a number of reviews that came in for you over the last few days, and it seems like a lot of clients are obviously tremendously happy with your connection. And that's one of the things at Noble Gold is that you really build a relationship, which is our focus here. We're not doing any AI or bots. We really focused on client to customer, relation, in a unique way, old school kind of way, I would say, right? Wouldn't you say that, Jake?
Absolutely. We build trust, we build education, and I'm going to get back to it, boss. So
all right, we'll talk soon. We'll see you on the next one.
We're talking to people today about investments. Let's see if we can get somebody. Excuse me, sir. Do you have a retirement account?
I do. I'm invested in some annuities.
Fixed income? How is that?
It was better a few years ago. Each year, it buys less and less, barely keeping up.
That's where gold can make a difference. Unlike fixed payouts, gold rises with inflation, so you're not stuck with a low fixed payment.
So gold isn't stuck in the past like my annuity?
Don't let inflation erode your retirement savings. Invest in gold. Invest with Noble.
All right, here we are back with our friend Micah. We got a lot of exciting news. I feel like every week there's something just so fascinating and interesting right now in the news. So obviously I'll let you get into it. I know we got tariff talk and a number of other things we got lined up. So I'll let you dive right in.
Yeah, thank you so much. So I've assembled another chart deck for our audience. So we'll get into what I'm calling our markets and metals update. So some stuff to cover today. If we want to bring up that chart deck, let's get through to the first slide here. This is the most interesting thing that I've come across. Most significant thing, I'd say, Colin. So let's go to the next one here just to visualize. So the Atlanta Fed, which is one of the 12 Federal Reserve banks, they have a GDP now live GDP forecast. And you can go onto their website. You can see what it's basically predicting for the end of the quarter. And what we are seeing really since Thursday of last week is their GDP predictions for Q1 have gone from plus 2.3% all the way down to a negative 2.8. That's more than a 5% swing in the last 48 hours, let's call it 2 business days. So what this is based on is economic data that came out both Friday and again yesterday. The primary driver of this is a weak consumer. So consumer spending is way down. What we're seeing is that the savings that people had accrued through the COVID years with PPP loans and checks they couldn't spend anywhere because of lockdowns, this XX savings is now gone. It's really impacting consumption of goods. The other big underlying data set that's contributing to this negative GDP rating now, this is a recessionary warning, is a lack of investment in housing. So people aren't renovating their homes as much. New builds are down. And obviously we know that real estate sales are down as well, significantly in the past couple of years. But all in all, this is a major red flag. I think recession calls a month ago were virtually zero. And now you've got one of the big Fed banks now predicting that we're pretty much going into a significant and very fast recession. Like, just look at the chart. So, things are really falling off. We'll see if this persists, but I can't imagine things getting better with tariffs, which you've obviously touched on and we'll get into a little bit more. But any thoughts or questions on this chart, Colin?
Well, yeah, I guess my question is, it's such a dramatic shift from a month or two ago. What does the Fed do with this? Not all the Fed locations have come up with this chart, so they're obviously looking at it in different ways.
Yeah.
But having that negative GDP, what tools would be in place for the Fed if other Fed chairs came to the same conclusion? What would they try to do? Because that's a pretty stark.
It is. It is. So I think the biggest thing, Colin, is going to be a change of tone from the Fed chair. So Jay Powell. I think we're going to see him going from a fairly hawkish tone where he's saying, hey, look, inflation's still running high. Jobs and employment look pretty good. This was all kind of at the end of December. And he's pretty much removed most of the scheduled rate cuts for this year. We went from like 8 cuts at the beginning of Q3 down to 2? I think now 1 at the end of the year. And so as much as they do still have inflation as a target and they're wanting to bring it down by holding rates higher for longer and trying to be data dependent, I think this new data from the Atlanta Fed is now going to have them going, well, we need to potentially switch gears and be open to rate cuts. I certainly think that the administration has alluded to the fact that they want rate cuts. Mostly what they've been focusing on, Colin, is trying to get the 10-year yield down, which is not something that the Fed controls. So I think one of the things that would actually cause the 10-year yield to come down would be if we have a stock market crash, which we're kind of in right now. We're going to go through that in just a second. So honestly, it wouldn't seem outrageous if Trump early on in his term is actually trying to cause a stock market crash with tariffs, trade wars, and all the other geopolitical stuff that's going on. The stock market
to get the 10-year down.
Get the 10-year down, which they can't control, and then get the Fed to start cutting on top of that. So really interesting. If this is,
but devil's advocate, why is it more important for the 10-year to go down than the stock market go up?
I think when you look at commercial lending, as far as commercial real estate, mortgages, all commercial debt is really based on the 10-year yield. And we know that the 10-year yield has actually gone up significantly since the September rate cuts started. And so they don't really control the bond market and the yields that are expected based on inflation expectations. And so they really do want to make it cheaper, more affordable, more cost-effective for businesses and individuals to be able to expand their credit and to be able to borrow to buy. And obviously being able to borrow to buy to offset the reduction in consumption that we're seeing would be a goal as well.
So your hypothesis here is that the stock market pulls back, which brings the 10-year down because there's more demand for the 10-year, which brings the price of the 10-year down. So I really want to lay this out for people because I think when people saw rates cut last September, they thought the 10-year would go down. They thought mortgages would go down. But as you've said, we don't control the 10-year. The Fed doesn't control the 10-year.
Yeah.
The way that we could have that happen, the stock market has a collapse or a big pullback. There's a lot of demand for 10-year treasury bonds because they're like, wait a minute, now
We
this
need
4.3% is attractive, right?
Exactly.
We want it. And that brings the price down because there's more buyers.
Exactly.
And now you have a 30-year mortgage. If the 10-year dropped, let's say 100 basis points, then your 10-year mortgage could be at maybe 5% or high fours, which would sort of save the real estate market.
That's exactly it. And the way I like to explain it is the bond price and the yield on the bond is like a seesaw. So if people are buying bonds to de-risk their portfolios from a falling stock market, the bond price goes up and the yield comes down. But if people are selling bonds, then the yield goes up. And so they kind of work in tandem, like that seesaw. So if we're going to see a real rotation of capital into risk off, which means money flowing into gold, of course, we're seeing that happen. But if it means money flowing into bonds, then that would bring the 10-year down and kind of accomplish bringing that down for Trump. Now, it also is early in his new term that he can probably blame whatever economic weakness we're experiencing now on the Biden administration. And actually, I think they're probably largely responsible for a lot of the problems that we're seeing and that we're experiencing. But it's convenient politically for him to see a stock market crash earlier on in his administration rather than later, because he can just kind of absolve himself of any responsibility.
Yeah. Let's talk about gold, what it's doing, S&P, recession.
Yeah. So this next chart, let's bring that up. This is just a historical look. Perhaps we can move our little thumbnails there so that we can look at how gold performs versus the S&P in a recession. So this historical chart goes back to every major recession in the US, how long it was, what the percentage change in the nominal price of gold was, and the nominal change in the price of the S&P. And by and large, not every time, but by and large, gold will greatly outperform the stock market during a recession. And honestly, I think we're seeing that now. Gold is already higher than the S&P in the last 12 months.
Right. For
gold to be outperforming the S&P before a technical recession is confirmed is exactly what happened in 2007. And if we want to look at the 2007-2008 recession and what happened there, well, you had a massive outperformance in gold versus the actual returns that you saw over that time span in the S&P. So I think we're gearing up for something very similar, although add to that all the various geopolitical tensions that we're seeing. And like you talked with Jake just a few minutes ago with NATO and all that other stuff, that just adds more fuel to the fire for the price of gold, which is, of course, exactly what we're experiencing right now.
Yeah. That 1973 number is pretty phenomenal. 87% increase in price of gold. It feels very similar to that, potential time period.
Yeah, that was a stagflationary period, which honestly is quite likely what we're going to expect here. Now, what stagflation is for our audience members that aren't familiar is when you have a stagnating and contracting economy, you're in a recession, but the price of all the goods and all the necessities, energy, fundamentals for every household, they continue to go up. So when you have a combination of a recession and high inflation, you get stagflation. And that's exactly when the metals perform best. That's actually where we are right now. If I were to make a prediction, we are going to, especially with tariffs and everything else going on, we're going to continue to see high inflation while entering a recession. We haven't been in stagflation since the 70s, which literally was the largest precious metals bull market ever. And I think we're going to see that probably outdone over the next 5 to 10 years.
Yeah, great chart.
So I've got I just want to kind of touch on the stock market, Colin, if you don't mind.
Yeah.
I think everyone, that has yet to roll over a 401k or an IRA is largely in a 70-30 stock to bond type of allocation. So we know that households and boomers in particular as a demographic are more exposed to stocks now than they ever have been. And that's at a time when the stock market is still relatively high, very overvalued on a technical and historical basis. So we've talked a lot about the Mag 7, the big 7 stocks that have essentially carried the US indices for the last 2 years. This is them just over the last couple of weeks now correcting and breaking support. We've talked about technicals. That bottom line is like a floor, and that top line is like a ceiling. And we've been more or less respecting the boundaries of that particular formation, but we've now broken down below there, which means we can actually see new lows. And my expectation is that we very well could, with all the various things going on in the world right now. So just to put some numbers to paper, we have lost $3.3 trillion of market cap in US stock indices over the last 10 days. So that is a loss of $330 billion every day for the last trading days.
Wow.
10 trading days, pardon me.
Yeah. Unbelievable.
So this stock market sentiment indicator correctly shows that we've now entered the extreme fear territory. So we could see a continuation of this trend for days, weeks, months. It really just depends on how bad it gets. So I think this is a relevant indicator just for people to know where we're at on the spectrum. We've talked about the importance, Colin, of NVIDIA with respect to the Mag 7, and it really has been a high flyer for the last couple of years. We now have NVIDIA just yesterday closing below the low that was seen in at the end of January, when this whole DeepSeek competitor had broken out and come into the news. And so that was a real disruptor to the dominance that NVIDIA has over the AI space. It had a 17% sell-off in 2 days.
Yep. Mm-hmm.
But we are now actually below those lows, which is a technical floor. If we are making lower lows now, moving forward, we could be in a bear market territory. Let's have a look at another important chart. This is the NASDAQ. Let's just throw our thumbnail screens to the other side if we can. Showing you, again, that band that I've drawn across there acted as a bit of a ceiling going into August, which was actually the last time we had a significant correction. But we have, since really the August lows, been able to make higher highs above there. So the NASDAQ has been making pretty much new all-time highs since, let's say, end of December. But we now have broken below that key channel, which again, like with the NVIDIA chart, means we're making lower lows and could actually be the start of a corrective phase for the indices. Now, this next chart, very, very important. It seems a little bit complicated, but I'm just going to distill it here in a couple of key points. This is the price of gold versus the NASDAQ, and it's a 30-year chart. So what we can see is on the far left, as the price of the NASDAQ went up and the price of gold went down, you get that downward movement in the ratio chart. So that means that the price of the NASDAQ is greatly beating the price appreciation of gold. But you can't see it, it's just behind my screen here. In 2001, what happened? The dot-com bubble. Dot-com bubble marked a 10-year period where gold beat the NASDAQ for 10 years. The NASDAQ actually went nowhere during that period, and we had a price increase in an ounce of gold from roughly $200 an ounce to $1,900 an ounce. So,
and we
gold,
cut rates then too,
exactly.
right? So that's what we're trying to do again now, right? And we're trying to cut rates again. Yeah. Because I was talking to somebody about this. I truly believe that we've set the real estate prices were set at a level for over 20 years that were not real prices. And so a lot of this is the market from 2001 to 2011. What the market is really doing is saying, yeah, I see this real estate thing happening, but really I believe in physical investments. I believe in gold. That's what's really the real values there. And those things will be consistent over time.
Absolutely.
And now we have to get back to a middle ground. I don't think interest rates go back to 3% anytime soon, but we have to find that middle ground so that people can just stay in their property, stay in their home.
Mm.
Otherwise, the banks fall apart. I mean, the whole thing falls apart, right? I mean, I think
Yeah,
that was a big lesson that hopefully we've learned for the past 20 years, that it just
I agree.
created an unbelievable real estate market that actually made no sense.
Yeah. But so the important part about this particular chart is that it illustrates that we're coming into a massive, likely decade or more long period where once the price of gold breaks out versus the NASDAQ, and we're right on that cusp, kind of on the right side of that chart, literally we're a couple points down in the NASDAQ and a couple points up in the gold price from breaking out, which will mark the entrance or the beginning of a new gold era where gold outperforms the NASDAQ, which is the tech stock index, for a period of 10 to 15 years.
Mm-hmm.
So like it did from 2001 to 2011, gold outperformed the NASDAQ. We have now a period that we're entering that will be exactly the same. So for me, this is a very exciting, generational opportunity. Gold's at all-time highs, or very close to, but it's nothing compared to where we're going in the next, like I said, 5, 10, 15 years.
Mm-hmm.
So we can move on. Now we can talk about tariffs a little bit. Of course, they're effective today. Colin, you mentioned that it's 25% on both Canada and Mexico, with China's being doubled from 10 to 20. We have no exemptions or exclusions from the tariffs. They are an across the board all imports tariff on Canada and Mexico. We continue to see massive, unprecedented, off the chart amounts of physical gold and silver coming into the commodity exchange in New York. We talked about that on our last interview a couple of weeks ago with respect to tariffs and the Fort Knox audits. So physical gold pouring into the US is either there's a huge institutional buyer, it's smart money, it's hedge funds, it's high net worth investors displaying for the world to see that the most crucial asset to own moving forward is physical gold and silver. They are laser focused on this asset class. It's the only way to explain why things are off the charts. Now, one of the interesting things I was mentioning to the team and to a client earlier this morning is we currently have pretty much a full inventory of one of my favorite products to sell, which is the Royal Canadian minted gold maples, silver maples, beautiful coins, quadruple 9, 24 karat gold coins.
Yep.
And actually one of the only quadruple 9 silver coins as well. Usually it's just 3 9s, but the maple is an exception to that. We're fully inventoried. Okay. But when we run out and when our stock is depleted, any new Canadian maples, gold or silver that we'll be bringing in are going to be at an additional 25% tariff. And I would tell people right now, get them while you can. Get them while they last.
And they're at great prices too right now, because we bought them before this, so you're getting, bullion products are at such good prices relative to the spot price. On the next one, Micah, when we get together, I'm going to show a picture of the 100-kilo gold coin that I was able to see, which is 5 9s.
Oh wow.
And when I saw that coin many years ago, it was worth like $6 million. And now it's, probably worth $8 or $9 million. Actually, it might be worth more than that now. I haven't done recently the calculations, but yeah, I want to show that to the audience because it's pretty amazing. I have
that'd be great.
Picture of the coin. It's basically the size of a tire, and then I have a 1 ounce coin in the middle.
Oh wow.
So I'll show that on the next live stream.
Yeah, that sounds really good. So yeah, I just think that everything that's going on is just, again, more fuel to the fire. I want to go to the next chart just to show you that the physical metals delivery is just ongoing. We have record amounts of gold coming into the COMEX. Again, we'd speculated, is this the Fed buying? Is it the Treasury buying? Are they refilling Fort Knox prior to the audit, which is going to kick off at some point later this month? I think it's the 19th of March. That happens to also be the next Fed rate cut decision day.
Wow.
So
big day. That's
big day for our business. Absolutely. And a lot of anticipation between now and then.
Yeah.
So gold, just, it's insatiable appetite here for whoever it is. We still don't know exactly. But silver, I want to, it's not been part of the conversation as much. Silver, I want to show this next chart that shows that we have record amounts of silver flying out of the LBMA. We're at the lowest levels ever for what remains in that commodity exchange for physical metal. So it's not just gold. Silver is as well getting gobbled up by, again, high net worth investors, smart money, institutional money.
So these investors are taking physical possession.
They are. They absolutely are. They don't want paper. They don't want to hold the futures contracts. They want physical metal.
Mm-hmm. Smart.
Yeah. Yeah. So let's just jump ahead here. So, we've just speculated who's doing the buying, right? And why. It's really significant. I think, and I actually had these points on my chart from the last time that we spoke, Colin. The only real reasons that the US would have for removing physical metals on this scale would be a number of things, but they're all big. So it's either the US thinks that Europe is about to get way less safe. Now, I had that written exactly the same way. This was prior to the Zelensky, NATO, Russia-Ukraine escalation. So that is definitely something. They think that Europe's going into war. World War III could be kicking off. And they just want to get all the metal that they can here. But also, you see this type of repatriation of gold prior to going into periods of major financial uncertainty. So it could also be that the US knows that they're going into recession. They may be, again, trying to cause a recession in the shorter term for political reasons, for strategic economic reasons too, get the 10-year yield down. But they could be doing it kind of for both of those. They think Europe's about to get less safe. War escalations could be around the corner. And we're coming into a period of financial instability. But it could also be some of the stuff we talked about where maybe they're reshoring gold reserves in Fort Knox prior to the audit. Maybe we're going to revalue gold to some astronomical number to help reduce our debt and improve our debt to GDP ratios. Maybe we're developing this gold-backed bond. Mm-hmm. But something I want to know just as kind of an important point is Nazi Germany, prior to them actually escalating invasions into Poland at the right before World War II, they repatriated a ton of their gold from the vaults in England. And so, if we think that's the direction that we're headed in is World War III or some kind of major geopolitical conflict, it kind of lines up with us wanting to get our metal here on, home turf before any of this crazy stuff happens.
Yeah, it makes perfect sense. Yeah, you want to have all of your assets under your roof, right? I mean, you don't want to have it in another place. So it makes sense that everybody's trying to get everything closer to home. Everyone's getting prepared for, whatever could happen. Any of these scenarios.
Yeah, exactly. So when it comes to geopolitical risk, this is an interesting chart. This is a moving average of the indication. It's a moving average of essentially periods of risk. And so it's not quite up to date. This chart is actually from the September of 2024. But what it shows you is that if we look at charts and kind of the way that they behave, if you want to look at the right side of that chart where I've got a little arrow drawn, is we are actually breaking out and we will end up seeing a major spike in the geopolitical risk index, which I think just adds data support to this idea of us taking all the gold out of Europe, bringing it home before something bad happens. Now, what is that something bad? You've got a couple of various events kind of marked here to show you and explain what these spikes can be caused by. But we're coming into something, right? If we were to see an updated chart, and I think we probably will at the end of Q1, so probably sometime next month, is already a spiking chart, which means we're coming into this type of territory again, elevated risk for everybody in the world.
Yeah, that chart would be more accurate if you put Israel and then fighting everybody, which it feels like they're always fighting off countries on every border at some point.
Exactly. Yep. So then I have one other chart here just showing you the price of gold. Now this is dated as well. It's only I found it. This is shows you what happens to the price of gold after a major conflict kicks off. So at the exception of the Gulf War, which was late 80s, early 90s, anytime there is a major war escalation anywhere in the world, you end up with a rising gold price. Now, the actual price of gold, this shows it down at around 1100 in 2015. We're already 3 times higher than that. So the price of gold on this, before any actual major escalations have started, the price of gold is already off this chart, right? So that just, again, backs up even more the fact that we're coming into an era where hard assets, physical metals with no counterparty risk, no sanction risk, every country, every high net worth investor, they're all prioritizing physical metals for good reason. And honestly, retail investors need to, it's kind of like, watch what I do, not what I say. They still probably want people to believe that there's no utility in holding gold for a large part of your portfolio. But obviously the data and history show you what happens when we kind of come into the territory that we're firmly in right now.
Michael, you're talking to people every day, clients of ours. Are these the risks that you lay out? Are these a lot of the risks that they feel? Is this why they're getting into physical gold and silver? What are people saying on the phones to you daily about this?
A lot of concern about the dollar, a lot of concern about the banks, a lot of concern about the stock market also nearing a corrective period or being at all-time highs. I would say that the dollar is probably a predominant risk.
Concern.
Yeah. And people wanting to hold an asset that's not dollar denominated, like physical gold and silver can be sold or priced in any currency in the world. So by holding physical gold and silver, you've actually now, you're dollar neutral in that specific asset. So I would say that's top of mind. But honestly, there's a lot of speculation out there about what's going on with all this gold getting repatriated as well. And like I've noted, it could be because we're going into recession. It could be because something major on a war front is happening in Europe, and people sense it. I mean, I think people really, more than anything, Colin, just sense that something is off. And I have those feelings too.
Yeah.
So I'm constantly doing this research in order to kind of piece everything together in my mind so that I can actually kind of create the narrative and explain to clients exactly what it is that we're seeing and why gold and silver are a great way to protect yourself from wherever we're going. But people just sense that something is off.
Something's not going right. They understand, they feel it. And even though the CPI hasn't gone up to 8 or 9% like before, it still feels like things are getting more expensive. Doesn't feel like the job market's that great. So, and it's like my grandfather said, it's better to be a few days early than a few months late. And I think that's the preparation that people are doing right now. And what I've seen with clients that I've talked to is they love the safety of gold. They love the opportunity in silver. And I think that's what I've really seen. I obviously talk about it a lot in my book, is just this incredible opportunity, the super cycle opportunity. And silver still hasn't moved the way gold has moved. And people are surprised by that.
It's frustrating.
It's
frustrating for those who've owned it for years, including myself. Like I always say, I'm an investor first and a sales guy next. I've been buying for 8 or 9 years.
Right.
90% of my portfolio is in silver. I own a little bit of gold that I bought back when it was $1,500, but the opportunity is in silver. Silver will grossly outperform gold when we get to that time. Now, when will it be? I think it comes once we have a true rotation of capital, once the stock market correction is really underway. But we have to remember that gold and silver's kind of typical behavior in a precious metals bull cycle is fairly predictable, and gold always makes new highs first. It's the metal that leads the trend, and silver, if gold is like the kind of calm older brother, and it makes it sort of newer highs first, and it's chugging along, steadily but surely, and silver's sort of the little sister that's kind of dragging way behind, and then kind of realizes that at one point, oh my gosh, my brother's gotten so far ahead of me. She's now going to have this kind of elastic slingshot move and get ahead of him in terms of a percentage appreciation, she always, without exception, silver always outperforms, but it's on what kind of time frame. And so I think we'll see 30-1 in the gold to silver ratio, which is the previous high from, or low technically in the chart, from 2011. So when 2008 hit and we had the global financial crisis,
Right.
gold tripled in 3 years, which is fabulous. And I think that gold's probably on track to do something similar over the next 3 to 5.
Right.
We could be looking at $8,000 or $10,000 an ounce gold by 2030. However, silver at $30 probably will get something closer to 200 or 300, and that's consistent with what happened after 08. Gold tripled, but silver went up 8.5 times.
Correct.
And so that gold to silver ratio from 2011 was a 30-1. We're right now at a 90-1.
Right. Right.
So the conversion strategy that I always ask my clients to consider is gold's great. You can't go wrong. You're never going to lose on an appropriate time frame. But with silver, you can either own 3 times more gold or make 3 times more money if we go from a 90-1
to a 30.
to a 30-1.
Absolutely. Yeah, it makes sense. I mean, listen, even if it goes 60-1, you're going to be happy there.
Absolutely. Absolutely. So I think in terms of, where we're at right now, this silver chart that's been up here for a couple minutes, I'm sorry I haven't spoken to it yet. This more or less kind of outlines what I think we're in for the next few months for silver. So we'll take a crack at that $35 mark, which was the high from October, right before the elections.
Yep.
And we might find some resistance there. Typically, when you get to a kind of an all-time high or a recent high, you're going to bop your head against that, like a bit of a ceiling. But I have no doubt that at some point over the next few months, we will go through that resistance at 35 into the high 30s and low 40s. And that's just for the spring. I think we could spend the summer consolidating there before we make a real run at breaking the actual all-time high of 50, which would probably be, in my opinion, sometime this fall.
Yeah. I mean, I've in doing this for so long, June, July sometimes can be sleepy.
Yep.
But I don't think this year we're going to see that same kind of sleepiness in the metals market. I think it's going to be pretty frothy this year.
2020 is a great example of that frothiness. So you're right. Seasonality for silver especially is, June, July.
Yeah.
Usually there's nothing going on. And last year was a good example. It went from $22 to $32, a 40% jump between March and May. So 2-month 40% return in silver.
Right.
But then it spent the summer months consolidating,
yeah.
going back to 28 before it ripped from 28 to 30, 35. So I think we could see a very busy year for us. Honestly, all this stuff is just fuel that's just being thrown on the fire. Fundamentally, the metals look great. Technically, the metals look great. Geopolitically, they look great. Again, watch what they do, not what they say. Every central bank is buying. Major stuff going on right now, Colin, that just all roads lead to gold and silver.
Absolutely. Yeah. And for anybody, watching, if it's your first time, you want to learn, talk to Micah, give us a call at Noble Gold Investments. You can talk to Micah, learn about precious metals. Obviously, we got into some depth, but everyone's situation is different. So you want to talk to him and
Absolutely.
he could walk you through the process. Someone that's been buying a lot of silver, owns gold, can go through our products, pricing, how the IRA works. But I think it's quite a unique time in the market. So again, Micah, thank you so much as
Pleasure,
always.
man.
So
Absolutely.
interesting.
Anytime.
And for anybody out there, if you have any questions, give us a call, Noble Gold Investments. We're here, live people. You can talk to people like us if you want to learn. But I think it's a great time to get educated on precious metals. So again, everyone.